Okay, we'll talk about non-trading concerns. Okay, now when it is trading, the trading concerns they buy and sell. If they are buying and selling, you call them as trading concern. If they are not doing buying and selling activity, if they're not involved in buying and selling activity, then it is not a trading concern. It is a non-trading concern. Okay. Now, what for these non-trading concerns are established? Set up. They're set up for the purpose of promoting sports, promoting culture, promoting art, okay, and also promoting leisure. Like for example, you have country club that is promoting leisure, and you have Lama Khan. That's a non-trading organization, okay, where the intellects join every evening to discuss and debate. So that is to promote social consciousness. Okay, so right now uh, you may see uh, organizations like Blue Cross, okay, that is to promote the animal protection. Now their purpose is more of service than profit. Profit may be you may see profit in such organization, but we don't call it profit, we call it surplus. The intention of running those organizations is not profit, so therefore not for profit organizations, non-trading concerns. Okay, now in the final accounts of these non-trading concerns, we have two types of statements. Okay, one is profit and loss account, another one is balance sheet. Balance sheet. Okay, what do you see in profit and loss account? Profit and loss account. Okay, now it is profit and loss account, but we don't call it profit and loss account because it's not a trading concern, but we call it income and expenditure. If it is profit and loss account, then the ultimate result will be either profit or loss. But the ultimate result here is not the profit or loss, it is the surplus or deficit. Okay, and you have balance sheet, the position statement where the position of assets and liabilities are mentioned. Okay, now the not-for-profit organizations or non-trading organizations, they maintain receipts and payments account. Receipts and payments accounts. Every time they receive money, they will record on the left side, that is receipt side, and every time they make payment, they write on the right side, that is payment side. Now, what do you receive? What is recorded on receipt side? You record the income, you record the liabilities. When you issue shares, cash comes in, you record it. When you borrow money, cash comes in, you record. Where? You record on the receipt side. Similarly, when you're selling something on behalf of the organization, you receive cash. Record that on the receipt side, that is left side. Okay, similarly, when you're making payments for purchase of material, cash goes out right on the payment side. Okay, and similarly, when you're buying an asset, let's say furniture, a motor car for the club, you're you're recording that particular transaction on the payment side of receipts and payments account. Okay, now we have to uh, you know uh, calculate opening capital and opening capital of the concern, right? For calculation of the opening capital, we will just the opening capital is it is arrived through a term called capital fund. Okay, capital fund. Now let's say you take the opening liabilities and the opening assets. The result of the difference between these two is capital fund. Okay, that's capital fund. Now, based on the receipts and payments account and the additional information through which you will make out the opening capital fund, we prepare income and expenditure account. It's like profit and loss account, but it is income and expenditure account. Though the name is income and expenditure account, we don't write the income on the left side. Okay, we write expenses on the left side and income on the right side. Okay, now expenses on the left side means the debit side, income on the right side means the credit side. Okay, income and expenditure account. Remember, expenses on the debit side, incomes on the credit side. Now, similarly, you prepare the balance sheet, and that is the end of the preparation of accounts, final accounts for non-trading concerns. That's it, as simple as that. But the point here is, what are the important items that we come across while preparing the non-trading concerns? I told you simply, the all expenses you take on the debit side. You take on the debit side. All incomes you take on the credit side. Okay. And all liabilities on the liabilities, assets on the assets, right? Income and expenditure account and balance sheet preparation. That's it. End of final accounts of non-trading concerns. But to prepare this, we have so many items which are complicated and confusing. Now, for example, shall we take one by one? Now, item wise, we'll take some of the important items we'll take. Donations is one of the prominent items we come across. Donations. Now, how to treat it? Now, the confusion here is whether to take a particular item as a liability or income, or to take a particular item as an asset or expense. If it is expense, then it comes in income and expenditure account. If it is an asset, it comes in the balance sheet. So the confusion comes here is which item is an asset, which item is an asset, which item is an asset, which item is an expense. Similarly, which item is income, which item is a liability. That's a confusion, right? The receipts and payments account, they do not segregate. All receipts, whether income or liability, recorded on one side. All payments, whether they are expenses or the assets, recorded in just one go or one list only. What we had to do is we had to segregate. To segregate, it leads to a lot of confusion and diverts our attention of preparing a proper and accurate balance sheet. Okay, right. Now, one of the items, as I told you, donations is one of the major items. Now, if it is a small item, then you treat it as income. If it is a big item, then you treat it as liability. Now, moreover, if it is given for a specific purpose, that particular donation, even if it is small, you treat it as a liability. If it is not mentioned for any specific purposes, it is just income. Okay. Then number 2 is legacy. Legacy. What is this legacy? Amount received, okay, through a will after the decease of a person, after the death of a person. He writes a will that this particular amount should be meant for so and so purpose. Okay, so legacy is a liability. Okay, it's written as per the will of the person who is dying or dead. Now, subscriptions. Okay, subscriptions are incomes because they are they are taken every year, right? Now, they are not capital in nature. Then life membership is beyond 1 year. Subscription is less than 1 year. Life membership is beyond 1 year. So it is a liability. Live membership is liability, whereas subscription is an income. Okay, honorarium paid is an expense. Okay, honorarium paid is an expense, and that's it. That's it. Okay, these are the important items. Now, other than this, I have some prepaid and outstanding. Yeah, prepaid and outstanding. This is another complication, very confusing complication. Let me tell you. Outstanding expenses. Outstanding expenses. Okay, what do you do with outstanding expenses? If they are at the end of the year, what you have to do is you add to the expenses concerned and take it into the liability. If it is in the beginning of the year, then you deduct from that respective expense and take it as outstanding. Take it in the opening liability. You know, when you are preparing the opening balance sheet to prepare the opening capital fund or just capital fund, to make out the capital fund, you prepare opening balance sheet. At that time, you take it the opening liability. Okay. Next, outstanding income. If it is outstanding income, add it to the respective or concerned income, and it is an asset if it is in the end of the accounting period. If it is in the beginning, it is to be deducted from the concerned income, and it is taken into the opening assets, okay, in the opening balance sheet. And if it is prepaid expenses, prepaid expenses at the end, deduct from the concerned expense and take it as asset, closing asset. But if it is in the beginning, this prepaid expense is in the beginning, add to the concerned expense and take it into the opening assets. And if it is prepaid expense, prepaid income at the end of the accounting period, deduct it from that concerned income and take it into liability. If the same thing is in the beginning, add it to that concerned income and take it into opening liabilities. So there are opening liabilities and opening assets. Okay, opening liabilities and opening assets. Let's say outstanding expense in the beginning, opening liability. Outstanding income, opening asset. Prepaid expense, opening asset. Prepaid income received in advance, okay, opening liability, right? Opening liability. Fine. And similarly, if it is at the end of the accounting period, outstanding expense, add to the concerned expense and drop it in liability. Outstanding income, add to that concerned income and drop it in the assets. Okay. Prepaid expenses, deduct from that concerned expense, drop in the assets. Income received in advance, deduct from that particular income and drop it in the liability. Why I'm telling this is, if others' money is with you, that's a liability. If your money is with others, it's an asset. Prepaid means you're paying in advance. Your money is with others, that's an asset. Income received in advance, you're receiving in advance, that's a liability. Okay, others' money is with you, that's a liability, right? So these are important points in the non-trading concerns, and you can ask me if any doubts you have.